Good. Let's see whether you really understand this whole concept of puzzle building. Line, wheel, and tire. Ignore value-added tax. Yay! Line, Wheel and Tire Pty Limited is in the business of replacing tires and providing wheel alignment services since 2005. The financial year end is 31 May. A fire rising on 28 February 2019 due to a short circuit destroyed 80% of the tire inventory on hand at that date. Luckily, Line was fully insured against the loss, and the averaging clause was not applied by the insurance company. Why do I give you that? Why do I tell you that? That means if the averaging clause was not applied, the insurance company has paid out the full amount of the loss that the company has suffered. The amount received from the insurance company as compensation for the loss suffered amounted to 88,900, of which 50,800 was for the inventory that was destroyed. The rest of the money covered the loss of income suffered. So if 50,800 Rand was for the inventory that was destroyed, and 80% of the inventory was destroyed, I can now work out what was the theoretical value of inventory on hand at the date of the fire by taking the 50,800 divided by the 80%. Because no averaging, they covered the full loss. The company maintains a profit margin of 30% on the purchase price of tires to determine selling prices. So if you have to write down what is your cost formula at this point of time, it would have been 100 plus 30 equals 130. Normal. During the month of January each year, Line drops its normal selling price of tires with 10%. So if his normal price is 130 Rand, what is 10%? 10% then equals 13 Rand. So what was his selling price with the special sales? It was 130 less 13, which gives us 117. And that was his selling price. So what was then his cost price plus his profit? Now remember, the cost price can never change. So if his cost price was 100 Rand before, it's still 100 Rand, because if you pay something 100 Rand for, there's nothing that's going to alter that fact. So 100 plus what equals 117? 100 plus 17 equals 117. So for my special sales, that was my markup or my profit formula. Now, during January 2019, the sales proceeds of the tires amounted to 234,000. So that was a special sale. So they tell me to ignore value-added tax. So the total sales proceeds was 234,000. There's my profit formula. So I can work out the profit as well, the gross profit that is, as well as the cost price of those goods sold. The company makes use of a periodic inventory system and uses the first-in, first-out method of inventory valuation. The statement of financial position as of 31 May 2018 showed the value of inventory tires on hand as 55,200, my opening inventory. The gross profit for the period 1 June to 28 February, so this is this current period up to the date of the short circuit, based on tires sold at normal selling prices, equals 312,900. So it's not my total. It's only on the normal sales that we have made this profit of 312,900. The company struggled to determine what the value of closing inventory at 28 February 2019 was because of the lack of proper up-to-date inventory records. The accountant asked you to propose a better way of accounting for inventory in the future. You have to prepare a document for him based on a hypothetical information that the opening inventory was 200 tires at 500 Rand each on 1 March 2019. Purchases of 2,500 tires at 510 Rand were made during the month, and 2,600 tires were sold during the month at normal selling price. Physical stock count revealed that 80 tires were on hand on 31 March. So this last paragraph is all based on hypothetical information. What is hypothetical information? Guys, that is just, I assume that if it was the situation, if it was the figures, what would the outcome have been? So this whole question was actually cut off in two separate pieces. The one was all about the loss, where you had to do certain calculations, and the second one, or the second part of the question, was all about the hypothetical information. So in the A part, prepare the trading section of the statement of profit or loss for the 9 months ended 28 February 2019 before inventory losses are taken into consideration. So he wants the profit or the trading section just before the short circuit or the loss incurred. The detailed composition of the cost of sales figure should be shown. So they told us it's a periodic system, so that they want to know what was opening inventory, what was purchases, and what was closing inventory. Good. So we're going to build the puzzle once more. And the puzzle again, and they ask me the trading section. So they give me the picture of the puzzle even before I didn't have to think about it myself. Statement of profit and loss for the 9 months ended 28 February. This is my total column. I had normal sales, I had special sales. Just coming back to this formula, we have established that our profit formula for normal sales is 100 plus 30 equals 130, and our profit formula for special sales was 100 plus 17 equals 117. Now let's see where can we start building the puzzle. The first thing that they gave us is what was the proceeds of the special sales. And the proceeds of the special sales was 234,000 Rand. They gave it to us. We have the profit formula, so therefore we can work out cost of sales and we can work out gross profit. So if we want to work out cost of sales, it's 100 divided by 117 multiplied by 234,000, which gives us 200,000. Well, the difference obviously is the gross profit, but I could have worked it out as well because it's 17 divided by 117 multiplied by 234,000, and that would have given me my gross profit of 34,000. Good. Then the question told me that our gross profit based on normal sales was 312,900. So we have that figure there. If we have that figure and we have this profit percentage, we can work out now from the profit figure what is the cost and what is the selling price. So if we want to have a look what the cost was, we would say, well, the profit is 312,900. If I want to work back to the cost price, I'm going to divide it by 30%. So 30 divided by 100 equals 30%, and that will give us 1,043,000. If I want to work back to my sales figure, it's going to be my profit figure, 312,900, multiplied by 100 divided by 30, because I want the sales figure. So if I work that out, it gave me 135,900. Obviously there, I could have added the 312 to the 1,043 to give me the 135,900. Or alternatively, I could have worked it out to check myself whether I've worked it out correctly. Now I have cost of sales for special sales. I have cost of sales for normal sales. So if I add the two of them together, I have total cost of sales. I have the sales figure for special sales. I have the normal sales figure. I've calculated that. So once more, if I add those two together, I get total sales. Sales less cost of sales equals gross profit. Now let's complete this middle picture now. They gave us opening inventory. They've told us that inventory tires on hand at the beginning of the year, 31 May, was 55,200 Rand. So I have opening inventory. I also have closing inventory, if you can remember correctly, because they've told us here 80% of the inventory was destroyed and I received 50,800 for that. So for closing inventory, 50,800 divided by 80% gave us 63,500. So what is the missing one? The balancing figure will then be our purchases figure. So that one less that one deducted from that one will give us 125,300, which is our balancing figure for purchases. And that is the A part of the question. The B part of the question says, explain to the accountant how the perpetual inventory system works to record inventory transactions. Also discuss the advantages of the perpetual inventory system opposed to the periodic inventory system. Now, obviously, there's a lot of things that you could mention. A few of the things that you can mention is the following. This method requires that inventory records are updated with all the movements in inventory, i.e. with every purchase and sales transaction that take place in date sequence. The biggest advantage of this method is that you always, on a perpetual basis, know what the value of inventory on hand is. And that obviously is out of a theoretical perspective. Out of a control perspective, you can now compare the value on hand, i.e. the physical value after you've done a physical stock count, with the theoretical value of stock on hand as per the stock records. Should there be vast differences between the theoretical value of inventory and the physical value of inventory on hand, a red flag is raised. The reason for this difference can be as a result of theft, which means that management must take action to prevent this from happening again in the future. The perpetual inventory system allows for better control for ordinary stock to ensure that sales are not lost due to a shortage of inventory. Because I can now predict, I know exactly how many items of what type of item is on hand, and I should know what is the demand for that item. So when my inventory is going to reach a certain inventory level, I'm going to place an order in order to make sure I will have inventory on my shelves. The perpetual inventory system allows for preparing financial statements at any time, eliminating the need to estimate closing inventory or performing ad hoc inventory counts. Because I have a theoretical figure on hand, therefore, in order to know exactly what is my inventory figure, I don't really have to perform a count. And you could have added a number of other valid points as well. Good. Use the hypothetical information, and this is this last paragraph of the question. They say use the hypothetical information to determine whether there was any inventory losses during March 2019 by using the perpetual inventory system. Right at the beginning, they've told us that this entity is using the first in, first out method. Somewhere. Company maintains 30%. There you are. The inventory is a periodic inventory system and use the first in, first out method of valuation of profit, of inventory. So, therefore, if we're going to use hypothetical information, we're going to start with our opening inventory here. 200 tyres at 500 Rand each. Remember, if there's unit prices, you use the table format to do your calculations. They bought another 2,500 tyres at 510 Rand each. 2,600 tyres were sold during the year, and a physical stock count revealed that there was 80 tyres on hand at the end of the period. So that means then we had opening inventory, 200 units at 500 Rand per unit, i.e. 100,000. We purchased 2,500 units at 510 Rand, i.e. 1,275,000. How many tyres did we have available to sell? 2,700 tyres. What was the total cost of that? 1,375. When we sold 2,600 tyres based on the first in, first method, we would have sold the first batch first. So we would have sold the 200 tyres at 500 Rand first. So that would have been the first ones going out of the door. 2,400 tyres of the second batch was also sold, and the cost price of that batch was 510 Rand per tyre. So 2,400 tyres at 510 Rand a tyre gives me 1,224,000. So the total cost of sales will be these two together, 1,324,000. Good. Now, so how many units do we have on hand at the end of the day? 2,700 plus 2,600 gives us 100 tires. At what price? That would have been out of the last batch that we still have on hand, so it would have been at 510 Rand per tire. So closing stock, according to our theoretical inventory records, was 51,000 Rand. Now, then they performed a physical stock count, and there was only 80 tires on hand according to the physical stock count. So therefore, guys, you can clearly see that 20 tires somewhere got lost. Now, the 80 tires would also have been valued at the last purchase price of 510 Rand. So that means that we have to write down our inventory in the GL account to a balance of 40,800 Rand. So the loss that we have incurred was 10,200 Rand. So the journal entry that you will pass is you're going to debit an inventory loss of 10,200 Rand. That's an expense account. And because this is trading inventory, it's going to be closed off against cost of sales. And you will credit our inventory account in the statement of financial position, the asset account, with the amount of 10,200. So at year end, you're going to show in the statement of financial position, physical stock on hand, 40,800.